What happens to the money in your pocket when a single tanker gets stranded in the Middle East?
It's a massive shift.
Right. Why does a conflict halfway across the world instantly reprice the currency you use every day? Buy your groceries, pay your rent, or even fund your business.
Yeah, people don't realize how connected it all is.
Exactly. How does a headline about a shipping lane thousands of miles away dictate the interest rate on your mortgage? Okay, let's unpack this, because the answers to these questions are going to completely change the way you look at the news. Welcome to this deep dive.
It's great to be here.
Our mission today is highly specific.
Mm-hmm.
And honestly, it's incredibly vital for anyone who wants to truly understand the hidden machinery of the global economy.
Absolutely.
We are going to decode exactly how massive energy shocks don't just stay confined to the oil markets. They don't just make your gas more expensive.
No, they do so much more than that.
Right. Instead, they launch these massive structured campaigns in the foreign exchange markets, the FX markets.
Which is where the real money moves.
Exactly. We are taking all the macro data, the economic frameworks, and the complex information we're exploring today, and we are turning it into your ultimate shortcut to understanding global capital flows.
Without the jargon.
Yes, without the overwhelming financial jargon that usually gatekeeps this kind of knowledge, you are going to see the invisible strings that move the global economy.
And to really grasp the scale of these invisible strings, we have to start by fundamentally shifting our baseline view of what oil actually is.
Okay, how so?
Well, the common trap is looking at it purely as a consumable commodity, putting it in the same mental bucket as copper or wheat or soybeans.
Right, stuff we just use up.
Exactly. But the data demands we look at it differently. Oil is a macro transmission mechanism. It is the very foundation of the modern global economic structure.
Because it's in everything.
Exactly. Think about the physical reality here. It powers the massive maritime shipping networks that move, 90% of global trade?
Yeah, roughly 90%.
Right. It sustains the heavy industrial production that builds our cities. It anchors a massive portion of the agricultural supply chain through fertilizers and mechanized farming.
So it's basically the base layer of the economy.
It is the base layer. Because it sits at the absolute, undeniable core of the global macro system, a change in the price of crude oil simply cannot remain isolated to an energy exchange in New York or London.
It has to spill over.
It has to. So today we are going to explore the mechanics of that ripple effect. We'll define the concept of a petrocurrency, dissect the complete anatomy of a strategic energy shock.
Which is fascinating, by the way.
Oh, it really is. And we'll
Yeah.
break down the 4 exact chronological stages of a market campaign that follows that shock. And finally, we'll look very closely at the institutional players.
The big guys.
Yeah, the true heavyweights of global finance who are orchestrating these movements behind the scenes.
I really love that phrase, macro transmission mechanism, because it really paints a picture of a massive interconnected engine.
That's exactly what it is.
Turning one gear forces every single other gear in the entire machine to turn, whether they want to or not. So let's dive into that domino effect.
Let's do it.
The macro framework shows us that when oil prices move, they ripple outward through the entire global financial system. But I want to trace the actual path. How exactly does that chain reaction play out in the real world?
Okay.
Walk us through the specific sequential steps of this domino effect. How do we get from a barrel of crude oil getting more expensive to an entirely different valuation for the currencies we use every day?
Well, the mechanics of this process are surprisingly rigid when you map them out. It operates as a sequence of highly predictable economic dominoes.
Okay, what's domino number one?
Domino number 1 is the raw oil price move itself. Let's assume a scenario where crude oil prices violently spike.
Got it.
Almost immediately, before the physical oil even reaches its destination, that price action triggers domino number 2, which is a global shift in inflation expectations.
Because everyone knows costs are about to go up.
Exactly. You have to remember that oil is the baseline input cost for virtually every human endeavor. If you're manufacturing plastic goods, flying commercial airplanes, or just fueling a fleet of delivery trucks, your baseline cost of doing business globally just skyrocketed.
So the market panics.
Not panics, but it adjusts. The financial markets don't wait for those costs to hit the consumer. They immediately begin pricing in higher future inflation across the entire economy.
Right. Because the market is forward-looking.
Precisely.
If it costs more to power a factory in Vietnam and fuel the cargo ship bringing those goods to Los Angeles, the final price of the blender on the store shelf has to go up.
The math demands it.
The cost just gets passed down the chain.
And that reality brings us to domino number 3, which is where the massive geopolitical wealth transfer actually begins. Trade balances alter.
Okay, break that down for me.
Every single sovereign nation on Earth falls into one of two categories. They are either a net importer of energy or a net exporter of energy.
There's no middle ground, really.
Yeah. Not at a macro scale. So when the price of oil skyrockets, the countries physically pulling the oil out of the ground and selling it suddenly see a massive, unearned influx of revenue.
Like hitting the jackpot.
Essentially, yes. Their national trade balances improve dramatically overnight.
Okay, and the importers.
The exact opposite.
Right.
The countries buying the oil, the manufacturing hubs that lack domestic energy resources, they're suddenly bleeding domestic capital just to keep their factories running and their citizens' homes heated.
Wow.
Their trade deficits widen violently. This structural shift in global wealth transfer leads us directly to the heaviest domino of all, domino number 4.
Which is?
Central banks are forced to step in and adjust monetary policy.
I want to pause on that central bank domino for a second, because this seems to be where the real financial leverage gets applied.
It absolutely is.
The people managing the money supply, like the Federal Reserve in the U.S. or the European Central Bank, they have to react because this imported inflation is heating up their domestic economies.
Yeah, they are institutionally mandated to react. A central bank's primary job is generally to maintain price stability, to keep inflation under control.
Right.
When an energy shock sends a wave of inflation through the economy, the central bank cannot just sit on its hands. They are typically forced to raise interest rates to cool down the broader economy.
To stop the bleeding.
Exactly, and to prevent that energy inflation from becoming entrenched in wages and services. And this final policy adjustment is the catalyst that forces the currency markets to rapidly reprice.
Because money moves to yield.
Bingo. Capital flows to where it is treated best. If a country's central bank is rapidly raising interest rates because their domestic economy is running hot from massive oil revenues, their national currency becomes highly attractive.
To who, exactly?
To global bond investors looking for a higher, safer yield.
Which perfectly explains why the foreign exchange markets, the FX markets, are the very first arena where these macro adjustments become truly visible to the public.
They're the leading indicator.
The FX market is essentially the real-time scoreboard for all of these underlying economic shifts. Picture a macro trader sitting at a terminal in London or Chicago.
Staring at the screens.
Right. The moment crude prices start surging, they aren't just staring at the ticker for crude oil futures. They're instantly pulling up highly specific currency pairs.
They absolutely are.
The data highlights pairs like the US dollar against the Canadian dollar, the USD CAD, or the euro against the Norwegian krone, the URNO.
Classic example.
The instant crude shifts. These traders are watching the capital flows violently adjust in these specific FX pairs because they know the dominoes are already falling. Let's zoom out for a second, because to really understand why those specific currencies are targeted, we need to talk about the petrocurrency framework.
Yes, we do.
Why Canada? Why Norway?
Well, the petrocurrency framework is the essential lens for understanding the fundamental asymmetry of the global economy. A petrocurrency is basically a national currency whose overall economic performance, global demand, and ultimate valuation are intrinsically linked to the export of petroleum.
Then the money that brings in.
Right, the massive revenues those exports generate. You mentioned the Canadian dollar and the Norwegian krone. You can also look at the Russian ruble.
Really?
These are classic, historically proven examples of currencies that display incredibly strong structural correlations with global oil markets.
The why here is the crucial part for anyone trying to track the money. It's all about the sheer volume of capital flowing across physical borders, right?
It is about the volume, yes, but it is also about the mandatory conversion of that capital.
Explain that part.
When oil prices rise, these exporting nations are essentially receiving a massive, spontaneous pay raise from the rest of the world.
Must be nice, uh-huh.
Yeah. They are exporting millions of barrels of crude, and they are receiving a tsunami of foreign currency in return. This massive influx of capital vastly improves their national current accounts. In the simplest economic terms, there is suddenly significantly more global demand for their domestic currency.
Why exactly? Because they have to convert it.
Exactly. The foreign buyers either need to acquire Canadian dollars to purchase the oil, or the Canadian oil producers are taking their foreign profits and converting them back into Canadian dollars.
To pay their workers.
To pay their local workforce, pay domestic taxes, and distribute dividends. The result of this mechanical flow is structural and inevitable. The domestic currency of the exporting nation strengthens significantly against its peers.
So that is the absolute dream scenario for the exporter.
Here,
They're swimming in capital, their national currency is strong, and their purchasing power on the global stage increases.
they can buy imported goods much cheaper.
Exactly. But we have to contrast that with the importer's nightmare.
It gets ugly for them.
For countries that are heavily reliant on importing energy just to survive, think of massive, highly industrialized manufacturing economies like Germany or Japan.
They don't have the domestic reserves.
Right, they don't have enough domestic oil to meet their needs. For them, a rising oil price is an absolute economic wrecking ball.
It creates a profound, multifaceted structural disadvantage. For an energy-importing nation, a sustained rise in oil prices means the fundamental cost of all domestic production skyrockets.
Every single thing they make.
Everything, every vehicle they manufacture, every chemical they synthesize, it all becomes significantly more expensive to produce.
Which crushes their global export competitiveness.
It crushes it. But the secondary effect is this severe capital drain. They are forced to send massive amounts of their own sovereign wealth overseas just to keep the lights on and the supply chains moving.
So they're just bleeding out.
They are bleeding their economy of capital and widening their trade deficits significantly. They find themselves in this toxic feedback loop.
Importing inflation while exporting capital.
Exactly. They're importing inflation through the high cost of energy while simultaneously exporting their own capital. Consequently, the global market heavily discounts their domestic currency, and it weakens.
It's a brutal double whammy for the importer. Your baseline costs go up, and the actual money you use to pay for things loses its value on the global stage.
It's a tough spot to be in.
But there's an ultimate amplifier to all of this, isn't there? The entire global financial system has a baseline setting that makes these moves even more explosive.
Yes.
It's not just a direct one-to-one trade between two countries.
No, not at all. The ultimate amplifier, the foundational reality of the entire framework, is that global oil transactions are overwhelmingly denominated in the United States dollar.
Ah, the petrodollar.
Exactly. This isn't just a historical quirk, it is a critical structural reality of the eurodollar system. It means that fluctuations in global oil prices are deeply intertwined with global dollar liquidity.
So every energy shock is.
Every energy shock is simultaneously a US dollar liquidity shock.
I want to make sure I understand the mechanics of this clearly. So when oil goes up globally, importing countries need more US dollars just to buy the exact same amount of physical energy they needed yesterday.
That's right.
It effectively creates a global scramble, a desperate hunt for US dollars.
That is the exact dynamic. Let's run a hypothetical scenario here.
Okay.
If you are the central bank of an importing nation and the global price of crude oil jumps from $60 to $80 a barrel, your country suddenly needs significantly more US dollars to acquire its baseline energy requirements.
Just to stand still.
Just to keep the lights on, you have to go into the foreign exchange market, aggressively sell your own local currency, and buy US dollars to settle those energy contracts.
And that just crushes their currency even more.
Yes, this massive forced selling drains dollar liquidity from your local economy and actively pushes the value of your domestic currency down even further against the dollar.
It's a vicious cycle.
It really is. For macro analysts and institutional traders, this underlying structure means that certain currency pairs become the natural, highly liquid vehicles used to express views on the energy cycle.
Like the USD CAD and your NOK pairs we brought up earlier.
Exactly. These aren't just random pairings on a screen. They are pure expressions of this exact geopolitical wealth transfer.
So traders use them as a proxy.
Right. If a massive hedge fund believes a major oil shock is coming, they don't necessarily want the logistical headache of buying and storing physical barrels of crude oil.
That sounds like a nightmare.
It is. They can express that exact same fundamental view, often achieving greater leverage and deeper liquidity by taking a massive position on the Canadian dollar or the Norwegian krone against a major importer's currency.
They're trading the math of the energy flow rather than the physical oil itself.
That's beautifully put.
And just to be absolutely clear for you listening, when we analyze the historical correlations of the Russian ruble or the Canadian dollar, we are looking purely at the cold, hard mathematics of energy revenue.
Strictly the math.
We are observing the economic mechanics of oil exportation and how those raw capital flows dictate currency valuation, completely independent of any political context or ethical judgment.
The market doesn't have ethics.
Right. The framework only measures the objective reality of the global macro system.
The market is fundamentally a discounting mechanism for capital flows. It is an emotionless calculator. It looks at who is gaining revenue, who is losing revenue, and it reprices the assets accordingly.
Makes sense.
Now, we have to distinguish between normal market noise and major structural shifts.
Okay, what's the difference?
Well, oil prices fluctuate every single day based on minor inventory changes in Cushing, Oklahoma, or slight shifts in regional manufacturing data. That's noise.
Right.
But the truly violent paradigm-shifting movements in these petrocurrencies, the ones that redefine global wealth, originate from what the data classifies as strategic shocks.
This brings us to the anatomy of a strategic energy shock. These aren't your standard Tuesday morning fluctuations.
No, definitely not.
These are events that suddenly, violently alter the global expectations of either supply or demand, forcing the entire system to reevaluate its math.
Instantly.
And the macro framework categorizes these into 3 distinct types of shocks. Break those down for us.
The framework identifies 3 primary categories: supply shocks, demand shocks, and policy shocks.
Let's start with supply.
Supply shocks are universally the most dramatic and instantaneous. A supply shock occurs when physical barrels of oil are suddenly and unexpectedly removed from the global market.
What causes that?
This can be driven by geopolitical conflicts, targeted sanctions that blockade exports, or massive physical infrastructure failures. Imagine a critical pipeline explosion or a catastrophic refinery fire.
So the oil literally just vanishes from the expected supply.
Exactly. The market reacts instantly because the physical reality of tomorrow's delivery has changed.
Okay, what about demand shocks?
Demand shocks operate on a slightly different timeline. They are usually more gradual in their onset, but equally impactful over the long run.
Give me an example.
These happen when the global appetite for energy changes dramatically. A severe, synchronized global recession that halts manufacturing and grounds commercial airline fleets. That is a massive negative demand shock.
Nobody needs the oil anymore.
Right. Conversely, a massive, rapid industrial boom in a developing nation requiring unprecedented amounts of diesel and electricity is a positive demand shock.
Okay, and the third one? Policy shocks.
Finally, we have policy shocks. These are driven not by physical limitations, but by government and institutional decisions.
Like what?
The imposition of a new, crippling sanctions regime, the sudden, coordinated release of millions of barrels from a country's strategic petroleum reserve, or the introduction of sweeping global environmental regulations that severely limit future drilling capital.
So the government steps in and changes the rules of the game.
Exactly. These policy decisions can structurally alter energy markets just as forcefully as a physical pipeline being severed.
To put this into a real-world perspective, when we look at the current geopolitical environment, it is incredibly charged.
It is extremely tense right now.
We are seeing the absolute textbook definition of a severe supply shock playing out in real time. If we focus on the Middle East and the waterways surrounding Iran, the logistical metrics are just staggering.
They are. The focal point of this specific contemporary risk regime is the Strait of Hormuz.
Tell us about that.
When macro analysts map out global energy infrastructure, this narrow waterway is arguably the single most critical choke point on the planet. The shipping data shows that approximately 20% of total global oil supply moves through this specific maritime corridor.
20%.
20%. Think about the scale of that. 1/5 of the world's entire energy lifeline, the fuel that powers global commerce, is forced to flow through a remarkably narrow, highly vulnerable channel.
That is an unbelievable concentration of systemic risk. And the cascading effects of disrupting that choke point aren't just theoretical, they are immediate and severe.
Very immediate.
We are looking at a situation where actual physical tanker attacks and explicit threats to mine or close the strait have functionally stranded hundreds of massive, ultra-large crude carriers.
They're just sitting there.
These ships simply cannot safely transit. And the knock-on effect of that logistical paralysis is that refineries thousands of miles away across major industrial hubs in Asia and the broader Middle East are being forced to physically halt their operations.
They have no input.
Right. They are shutting down because the raw crude oil they rely on to produce diesel and gasoline simply isn't arriving. It's physically trapped at sea.
It's a complete logistical bottleneck.
And this sudden physical removal of supply from the market is exactly what sends raw crude oil surging above $84 a barrel in a matter of hours. It is the brutal reality of physical supply and demand playing out in an extreme stress scenario.
And this is where we have to separate the human element from the market mechanics.
How so?
To view this purely through the lens of macro market catalysts, these geopolitical events, the stranded vessels, the halted refineries, the violent disruptions to established shipping routes, they are objective, factual market inputs.
Just variables in an equation.
Right. They represent a fundamental mathematical repricing of global risk and a physical constriction of global supply. For the massive financial institutions, the catalyst is the disruption itself.
And their job is just to react to it.
Their only job is to aggressively price in the long-term economic consequences of that disruption across every asset class.
We watch these headlines, we see the chaos unfolding on the news. But the real story is how that sudden, violent spike in price doesn't just end there.
It's just the beginning.
It doesn't just peak, cause a panic, and fade away into next week's news cycle. It transforms. The initial shock turns into a highly structured, deliberate, and prolonged market campaign.
This concept is perhaps the most crucial takeaway in the entire macro framework.
It really is.
It is the key to seeing the matrix. Financial markets do not react randomly over the long term.
It feels random sometimes.
It does. What initially looks to the outside world, to the person watching the evening news, like a sudden, chaotic geopolitical event, gradually evolves into a highly structured, deliberate market campaign.
Okay.
There is a specific, measurable anatomy to how this unfolds, and the data outlines 4 exact stages that dictate how massive sums of global capital move in response to the shock.
Now here's where it gets interesting. Because understanding these 4 stages is like having the actual blueprint to the financial markets.
It's the playbook.
It takes the terrifying chaos of global events and turns it into a readable map. So let's walk through this evolution step by step, day by day. Stage 1, the information shock.
Right.
What exactly happens in the first few hours?
Stage 1 is the immediate visceral flashpoint. The news breaks on the terminal.
Okay, the headline hits.
Let's use our previous example. A headline crosses the wires that a major critical shipping lane in the Middle East is blocked by military action.
Boom.
At this precise moment, physical commodity traders are the absolute first to react.
Why them?
Because they are the participants sitting closest to the actual physical supply chain. Their trading algorithms and their logistical managers are tracking the real-time physical movement of actual barrels of oil.
They see it happening in real time.
Exactly. The market reaction here is instantaneous and often incredibly violent. Oil prices gap higher on the charts. This is the initial shockwave. It is a mad scramble to secure physical supply.
Just pure panic buying.
Pretty much, but it is crucial to understand that at this specific stage, the broader financial world, the massive pension funds, the equity managers, is still just waking up to the news. They haven't moved yet.
That makes perfect sense.
Yeah.
The commodity guys are already trading the physical reality of empty tankers, while everyone else is still reading the headline and drinking their morning coffee.
Exactly.
Which leads directly into stage 2, macro narrative formation. This is where the story gets built for the rest of the market. How does that transition happen?
In stage 2, the shockwave moves from the physical market into the intellectual realm of the broader financial sector. The financial media, the chief economists at major banks, and the macro analysts step in. They take that initial raw, chaotic event, the blocked shipping lane and the spiking oil price, and they start framing it in much broader economic terms.
They start analyzing the fallout.
Right. The discussion pivots away from just the daily price of a barrel of crude, and it aggressively expands into the macro implications.
Yeah.
You start seeing detailed reports on global inflation risks.
Forecasts and models.
Analysts start running complex models, calculating exactly how this specific energy shortage will impact global GDP growth over the next 4 quarters.
So they're building the case.
And crucially, the conversation turns heavily to how central banks are going to be forced to respond to this new, unavoidable inflationary pressure.
I want to push back on that slightly, because to an outsider, this narrative formation phase just seems like a bunch of talking heads on financial television debating theories.
It can look that way.
Why is this phase a structural necessity for the market? If everyone knows oil went up, why do they need a narrative?
They need a narrative because narrative synchronizes expectations.
Yeah.
And synchronized expectations are required to move billions of dollars.
Oh, that makes sense.
Before a massive institutional player, a sovereign wealth fund, or a global macro hedge fund is going to commit $10 billion to a new position, they need a cohesive, defensible framework that justifies taking that risk to their investment committee.
They need a reason on paper.
Yes. The narrative formation phase aligns the thinking of pension funds, asset managers, and institutional allocators across the globe. It creates the required consensus view.
Like everyone nodding in agreement.
Right. The consensus view that, yes, the specific energy shock is going to create persistent, sticky inflation, and therefore we have a fiduciary duty to adjust our portfolios to protect against it.
So it's about CYA for the big funds.
Basically, without that synchronized narrative, without everyone agreeing on the rules of the new game, you don't get the sustained, unidirectional momentum required for a long-term campaign. It would just be noise.
That is a massive light bulb moment. They are literally building the logical foundation required to authorize the trades.
Cursives.
And once that paperwork is signed, so to speak, what comes next is the heavy lifting. We enter stage 3, capital reallocation.
This is where the actual structural shift in global finance occurs.
The money moves.
The macro narrative has been firmly established, the institutional risk has been assessed and approved, and now the massive players start moving the real money.
Ooh, exactly.
Global macro funds, specialized commodity trading advisors, and institutional asset managers begin violently reallocating vast amounts of capital. They start intentionally and aggressively increasing their exposure to the energy exporters we defined earlier.
So they're buying up the petrocurrencies.
They are buying the petrocurrencies in massive blocks. And it's at this specific stage, stage 3, that you see oil-linked currencies make their truly decisive, undeniable structural moves on the charts.
The breakout.
Yes. The Canadian dollar, or the Norwegian krone, will start breaking out of their previous multi-month trading ranges. Not because of a technical indicator, but because the sheer physical volume of capital flowing into them is overwhelming the sellers.
The dam breaks and the capital floods in.
It's a wave.
And once that massive capital has established its position and the trend is clear, we enter the final and usually longest phase. Stage 4, the campaign phase.
In the campaign phase, the sudden, highly volatile reaction of stage 1 has completely matured into a persistent, orderly, long-term structural trend.
It settles down.
The broader market has fully digested the new geopolitical reality. During this phase, the trend itself becomes the dominant, self-sustaining feature of the market.
This requires a massive perspective shift for you listening, because our human psychology is entirely wrong for this phase.
We are wired completely wrong for it.
Typically, when you see a currency chart going up steadily for weeks, and suddenly it drops sharply by 2% in a day, human nature is to panic. You think, oh no, the run is over, the news changed, it's crashing.
Right, the sky is falling.
But in the context of a stage 4 campaign, you have to visualize these sudden pullbacks in price, not as a reversal of the trend, but as deliberate, engineered opportunities.
They're buying opportunities.
The massive institutions that are driving this campaign use those temporary dips to accumulate even more assets at a better price. They aren't panicking, they are reloading their weapons.
So they are.
We keep mentioning these massive institutions and these large players. Let's actually pull back the curtain on this. Who is actually moving the needle here? Who is writing these billion-dollar tickets? Let's break down the institutional incentives driving these campaigns.
To truly understand why the market moves the way it does, you have to understand the specific incentives of the puppeteers pulling the strings.
Okay, let's look at the suspects.
The macro data profiles 4 main institutional actors who dictate the massive flow of capital during these energy shocks. Let's look at the first group, commodity funds. Now, the baseline assumption is that a commodity fund just buys and sells crude oil futures contracts.
Right, they just trade oil.
But in reality, the sophisticated funds frequently use foreign currency exposure to aggressively amplify their returns.
How does that work?
If their core macroeconomic thesis is that crude oil is going to march to $100 a barrel, they know fundamentally that the currency of an oil exporting nation is going to appreciate as a direct mathematical result.
So they buy both.
Yes. By buying the petrocurrency alongside the physical commodity, they're essentially applying a form of macro leverage to their view. They are capturing compounding returns from both the rising price of the raw material and the strengthening of the associated sovereign currency.
Wait, if the commodity funds know the petrocurrency is going to rise inevitably, why bother dealing with the physical oil contracts at all? Why not just dump all their capital into the Canadian dollar and skip the margin requirements of the oil futures?
Because it's about optimizing risk-adjusted returns across different asset classes.
Okay, spread the risk.
Oil futures provide the immediate high beta reaction to the physical shock, while the currency provides a broader, often less volatile, macroeconomic yield. They balance each other.
That makes sense.
And that brings us to player number 2, who operates on a scale that is almost difficult to comprehend for a normal person. Sovereign wealth
These
funds.
are the heavyweights.
The absolute heavyweights. These are the massive state-owned investment vehicles of nations that generate unimaginable revenues from natural resources. Think of the massive funds in the Middle East or Norway's government pension fund.
To put that into perspective, so while I'm groaning at the gas pump because it cost me an extra 20 bucks to fill up my Honda Civic, a sovereign wealth fund is literally taking that exact 20 bucks, combining it with billions more, and using it to buy a skyscraper in London or a massive tech company in California.
That is precisely the dynamic on a global scale.
It's wild to think about.
When oil prices surge, these exporting nations are suddenly flush with tens of billions of dollars in excess, unbudgeted revenue. They don't just leave that cash sitting idly in a central bank checking account.
They put it to work.
They are mandated to recycle those massive petrodollar revenues through global investments to secure their nation's financial future. They buy foreign equities, they acquire international real estate, they purchase U.S. treasuries.
And that takes currency conversion.
Massive conversion. To execute those massive cross-border purchases, they have to physically exchange currencies in the open market. This mandatory, relentless recycling of petrodollars creates colossal, undeniable foreign exchange flows that structurally and mechanically move the global currency market.
They are a fire hose of capital.
The fire hose that cannot be turned off.
It's a wall of money that has to be deployed, regardless of what the chart looks like. Player number 3 brings us back down to the actual companies pulling the oil out of the ground. Energy corporations.
Yes, the producers themselves.
How are massive companies like Exxon or BP actually moving the global FX markets?
Through the absolute necessity of corporate hedging. Think of massive energy corporations as incredibly complex global businesses that are desperately trying to lock in their profit margins in a highly volatile world.
Right.
Here is their fundamental logistical problem. The vast majority of their global revenue is earned in U.S. dollars because that is the universal currency for pricing oil.
Right.
However, their massive operational costs, paying their tens of thousands of local workers, maintaining their domestic pipelines, paying their local sovereign taxes, are mostly incurred in their local domestic currencies.
I see the problem.
If you are a massive Canadian oil sands producer, you get paid for your crude in U.S. dollars, but you pay your massive expenses in Canadian dollars.
So they have massive currency risk.
Huge risk. To protect themselves against wild currency fluctuations that could wipe out their profit margins, these corporations engage in massive continuous hedging operations. They sell their expected future U.S. dollar revenues and aggressively buy their local currency in advance to lock in a guaranteed exchange rate.
So they're creating massive demand for their own currency.
Exactly. When oil prices are rising rapidly and their expected future dollar revenues are swelling, the sheer immense volume of their forward hedging activity creates sustained, structural, corporate demand for their local currency.
They are just acting like smart, conservative businesses trying to manage their budget risk. But because of their sheer colossal size, their everyday risk management physically moves the global exchange rate for everyone else.
It moves the needle for the entire world.
It's fascinating. And finally, player number 4, perhaps the most powerful entity of them all, central banks.
Central banks are the ultimate, undisputed referees of the macro system. And when energy costs rise significantly, they are the ones forced to blow the whistle.
Because of the inflation.
Right. As we detailed in the domino effect, higher energy costs inevitably and stubbornly bleed into broad consumer inflation. When that inflation gets too hot and threatens the stability of the economy, the central bank has a mandate to cool it down, typically by tightening monetary policy and aggressively raising interest rates.
Which acts like a magnet for capital.
Yes. This policy response is the ultimate, undeniable catalyst for long-term currency trends. When a central bank raises rates, global capital pension funds, bond investors, floods into that currency seeking the higher, safer yield.
So they basically pour gasoline on the fire.
They do. So the central bank's forced reaction to the oil shock essentially supercharges and institutionalizes the currency trend that the other 3 players have already started.
Okay, let's unpack this visually. We know the fundamental economic drivers, we know the 4 distinct stages of the campaign, and we know the 4 massive institutional players writing the checks.
We have the whole picture.
But how does this actually manifest on a screen? For the traders and analysts looking at the charts every day, what is the visual anatomy of this campaign?
The visual life cycle of an oil-linked FX campaign is remarkably structured. Once you know what to look for, it is almost like reading a repeating, predictable pattern in the data.
Walk us through the chart.
The initial phase on the chart is the catalyst. This is stage 1. It visually manifests as a sharp, violent, vertical movement. Prices gap and move rapidly as the market violently processes the new physical reality.
Just a straight line up.
Yeah, a spike. This vertical spike is followed almost immediately by an early positioning phase. On the chart, this period often looks chaotic, high volatility, wild intraday swings, but overall directional consolidation.
It's just messy.
Very messy. This is where the speculative traders, the nimble hedge funds, the algorithmic momentum traders, the fast money are jumping in, battling each other, trying to align themselves with what they believe is the emerging macro narrative before the big players arrive.
They are the surfers trying to catch the wave before it really swells and breaks.
That's a good analogy. But the chart really starts to tell a definitive story when the institutional confirmation arrives. This is stage 3.
When the big boys show up.
This is when the massive sovereign wealth funds and the lumbering global macro funds finally start deploying their colossal capital. On the chart, the wild volatility often subsides, and the trend becomes much more stable, much more relentless.
It just grinds.
Exactly. The daily candlesticks show a clear, persistent direction. The market grinds higher. But what I find most fascinating from a purely structural and psychological perspective is the behavior during the mature expansion phase.
All right, let's get a little technical here. Break down the expansion phase for us. Why is this specific part of the chart so interesting and, frankly, so dangerous for the average person?
During the expansion phase, the market campaign is fully mature. Everyone knows the narrative, and you start seeing very specific engineered structural behaviors.
Like what?
First, the corrections, the inevitable pullbacks against the main upward trend become remarkably shallow. The market simply doesn't retrace very far before aggressive institutional buyers step right back in to defend their positions.
They won't let it drop.
Right. But secondly, and far more importantly for understanding market mechanics, you see engineered liquidity events.
Break that down. What is a liquidity event? Like a stop run?
Yes, a stop run is the classic example. Let me give you an analogy to visualize this.
Please do.
Think of a massive institutional stop run, like violently shaking an apple tree before you climb it.
Oh, yeah.
The massive financial institutions are the climbers. They want to get to the top. But they need the weak, loose apples, the retail traders with tight stop-loss orders to fall out so they have clear footing and room to operate.
Brutal.
It is. A stop run manifests on the chart as a sharp, violent, but very brief plunge in price against the prevailing trend. To the retail trader sitting at home watching their screen, this sudden drop looks like absolute disaster.
They think the trend is over.
They think the macro narrative was wrong, the trend is crashing, and the sky is falling. Driven by fear, they panic and sell their positions at the market price.
Wait, so the institutions actually need the retail traders to panic?
Yes, exactly. To the massive institutional participants, this is not chaos. It is a highly deliberate, necessary mechanism.
Why is it necessary?
Large institutions face a logistical problem. They cannot simply buy $1 billion worth of currency in a normal market without pushing the price up massively against themselves, ruining their own average entry price.
Right, there isn't enough supply at that exact price point.
Exactly. They desperately need liquidity. They need a massive surge of people willing to sell to them at a specific moment. So when a stop run occurs and retail traders panic sell in droves, the large institutions use that sudden manufactured flood of sell orders as the exact liquidity they need.
Wow.
They use it to deliberately scale up, absorb the selling, and add massive volume to their long-term positions without moving the market against themselves.
That is such a vital, terrifying insight into how the game is actually played. The institutions literally require retail panic to fill their orders efficiently.
It's just market mechanics.
This is exactly why understanding the underlying macro picture keeps you from panicking. If you understand the fundamental thesis, if you know why the Canadian dollar should be structurally strengthening based on global oil flows and central bank policy, then a sudden, violent 2% drop on the chart doesn't terrify you.
You see it for what it is.
You recognize it for what it actually is. The giant institutions violently shaking the tree, clearing out the weak hands so they can buy more inventory. It completely changes your entire psychological approach to risk.
It really does. It gives you an edge.
And to prove that this entire macro framework isn't just academic theory, we have to look at how it is actually played out in the real world. History is the ultimate undeniable guide here.
Yes, the data from the past is clear.
And the macro data gives us two incredibly clear, contrasting historical precedents that prove exactly how powerful and destructive these campaigns are. I want to dedicate some serious time to this. Let's look at case study one, the 2014 oil price collapse. Walk us through exactly what happened.
The 2014 collapse is a textbook, devastating example of a structural petrocurrency unwinding. To understand the currency move, you have to understand the fundamental catalyst.
Set the scene for us.
In the years leading up to 2014, crude oil had been comfortably trading near or above $100 a barrel. But underneath the surface, a massive supply shock was building, not from a war, but from technology.
The shale boom.
Exactly. The United States shale revolution was rapidly bringing millions of new, unexpected barrels of oil onto the global market. The breaking point occurred in late 2014, notably around the OPEC meeting in November.
What happened at the meeting?
The market expected OPEC to cut their own production to accommodate the new U.S. supply and keep prices high. Instead, OPEC, led by Saudi Arabia, made a strategic policy decision to maintain their production levels.
So they basically played a game of chicken.
Yes, they essentially launched a devastating price war to defend their global market share and try to bankrupt the U.S. shale producers.
So we have a massive surge in structural supply, colliding with a deliberate policy shock from OPEC. The result was absolute carnage in the energy markets.
Carnage is the correct word. Over a relatively short, brutal period, we saw global crude oil prices absolutely plummet from over $100 a barrel down to below $40 a barrel.
Oh, it's a free fall.
A massive structural downward shift in the fundamental pricing of global energy. And the macroeconomic devastation this wreaked on the currencies of oil exporting nations was profound and long-lasting.
I want to visualize the impact of that. For a country like Canada or Norway, it must have been a catastrophic shock to their national balance sheet.
It was a sudden, violent rewriting of their national wealth. Countries that were previously enjoying massive multi-year inflows of foreign capital from expensive oil suddenly saw their primary sovereign revenues slashed by more than 60%.
That is just brutal for an economy.
The macroeconomic dominoes we discussed earlier fell in violent reverse. Their massive trade surpluses collapsed into deficits. Domestic inflation expectations plummeted, raising the specter of deflation. And their central banks?
Crucially, their central banks had to abruptly reverse course, shifting from a hawkish stance to frantically cutting interest rates to accommodate a severely weakened, battered economic outlook.
And how did that look on the charts?
On the foreign exchange charts, the reaction was a textbook stage 4 campaign, but to the downside. Currencies like the Canadian dollar and the Norwegian krone experienced brutal, unrelenting, prolonged depreciation against the U.S. dollar.
The bottom just fell out.
The USD-CAD pair skyrocketed. It is vital to note that this wasn't just a sudden panic crash that magically recovered a week later. It was a grueling multi-year market campaign driven by the inescapable fundamental mathematical reality that their primary national export was suddenly worth vastly less on the global stage.
Global capital just fled those economies.
It fled, and it didn't come back for a long time. It was a structural repricing of their entire national value, and it took years for them to claw back. Now, let's contrast that devastation with case study 2, which is much more recent and fresh in everyone's memory. The 2022 energy shock surrounding the Russian invasion of Ukraine. This was a completely different animal.
It was the exact inverse of the 2014 dynamics. In early 2022, the global economy experienced a massive, sudden, and violent supply shock catalyst.
Right.
The geopolitical realities of the invasion and the subsequent immediate imposition of severe Western sanctions created unprecedented disruptions to global energy flows.
The market panicked.
The market instantly had to price in the terrifying potential removal of millions of barrels of Russian oil and natural gas from the global supply chain overnight.
Just gone.
There was a frantic physical scramble by European nations to secure alternative energy supplies at any cost. This drove global crude oil and natural gas prices sharply and violently higher.
And exactly according to the mechanical rules of the petrocurrency framework, this massive price spike structurally strengthened commodity-linked currencies.
Yes, it did.
The petrocurrencies of nations that could still freely export their energy, like Canada, Norway, and broadly, the Australian dollar, saw tremendous structural inflows of foreign capital as the world desperately pivoted to buy their resources.
Exactly right.
While simultaneously absolutely crushing the currencies of the energy importers, countries in Europe and Asia suddenly had to find the massive amounts of capital to pay exorbitant, panic-driven prices just to keep their electrical grids functioning and their citizens from freezing.
Oh, it was a massive wealth transfer.
And again, to reiterate our strict focus on the data here, when we look at the events of 2022, we are analyzing them strictly in terms of their mechanical impact on physical oil prices, logistics, and the resulting mathematical capital flows in the FX markets.
Absolutely.
The macro framework only measures the economic reality of supply, demand, and currency valuation. It does not factor in politics.
That is the only way to objectively trade, analyze, or survive these events. You have to separate the intense geopolitical emotion from the cold macroeconomic reality of capital flow.
It's the only way to see clearly.
These two historical episodes, the catastrophic collapse of 2014 and the violent upward surge of 2022, perfectly illustrate how an initial headline-grabbing oil shock doesn't just create a temporary blip on a trader's radar.
It changes everything.
It fundamentally and structurally reshapes the long-term trends of global currency markets for months, and quite often for years at a time. The capital flows simply take that long to fully reposition.
So, bringing this all together, what does this actually mean for the person trying to navigate these markets today? How do we take all this high-level institutional macro theory and translate it into a strategic playbook?
That's the key question.
If I am looking at my screen tomorrow, how do I interpret this information strategically so I'm not just reacting blindly to news headlines?
For anyone actively managing capital, whether you are a professional macro analyst at a fund or an individual trader protecting your portfolio, the ultimate daily challenge is differentiation.
What do you mean by differentiation?
How do you know if a terrifying geopolitical headline is just going to cause a temporary 3-day price spike in crude oil that fades away, or if it is the genuine catalyst for a massive multi-month institutional campaign?
How do you tell the difference?
The secret to differentiation lies in a concept we call cross-market confirmation. You simply cannot just look at the price of crude oil in isolation. You have to look at the entire macro transmission engine simultaneously.
You have to see if all the individual gears are turning together in the same direction. What exactly does that look like?
You are looking for perfect, undeniable alignment across different asset classes. When a true institutional stage 4 campaign is initiating, you will see oil prices surging. That is step 1.
Okay, oil goes up.
Simultaneously, you must look at the bond market. You will see global government bond yields reacting sharply higher as the massive bond market prices in the new, unavoidable inflation expectations.
The yields follow the oil.
And concurrently, you will see the commodity currencies, the petrocurrencies we've discussed, breaking out of their technical ranges.
So it's a trifecta.
Yes. When crude oil, sovereign bond yields, and the FX markets are all moving in perfect synchronized harmony, that is your definitive, high-probability signal.
That's the green light.
That cross-market confirmation tells you that this isn't just speculative noise from day traders. It is massive institutional capital physically repositioning itself across the entire global financial system. The heavyweights have entered the room.
That is the footprint of the giant. When the whole system moves together, you know the big money is driving the trend, and you can ride their coattails. But nothing lasts forever in the markets.
Very true.
How do you know when the campaign is finally exhausted, when the
Right.
massive funds are packing up? When do you get off the ride?
You look for the exact opposite of confirmation. You look for structural exhaustion.
What does that look like?
Exhaustion usually manifests in the data as divergences. For example, let's say the geopolitical conflict drags on and crude oil prices make a new marginal high, pushing up to, say, $95 a barrel. But critically, the Canadian dollar fails to make a new high alongside it. In fact, it might even start creeping lower.
That's a red flag.
That divergence is a massive, glaring warning sign. It suggests mechanically that the institutional appetite to keep buying the currency has faded. The big money has stopped allocating, even though the raw commodity is still inching up on momentum.
What else do we look for?
You also look for a sudden, dovish shift in the central bank's posture. Perhaps the Bank of Canada signals that they are done raising rates because the broader economy is starting to crack under the pressure.
They hit their limit.
Or, finally, the underlying geopolitical narrative simply falls apart. The blocked shipping lane is cleared by naval intervention, the immediate crisis is resolved, and the fundamental reason for the panic-driven capital flight evaporates.
The story ends.
When the macro alignment breaks, the campaign is nearing its end, and the smart money is already exiting.
This entire framework is just incredibly illuminating. It takes something that seems so hopelessly chaotic and random, global geopolitics, wars, shipping logistics, and currency valuation, and reveals the rigid mathematical institutional structure operating underneath it all.
It brings order to the chaos.
As we look toward the future, it really begs a massive question. Are these massive oil-driven currency campaigns eventually going to fade away? We hear so much every day about the global push toward renewable energy, the massive adoption of electric vehicles, the investments in solar and wind power.
Yes, the transition.
Is this entire petrocurrency framework destined to become obsolete in our lifetime?
The current data and the realities of global infrastructure strongly suggest the exact opposite.
Really?
Despite the massive, well-publicized and necessary global investments in renewable energy transition, the harsh physical reality is that crude oil remains stubbornly, deeply embedded in the absolute core of the global economy.
It's hard to replace.
It is. Think about the specific industrial sectors that are the hardest and most expensive to transition away from fossil fuels. Global commercial aviation, the massive maritime shipping industry we discussed.
They can't just run on batteries.
Exactly. The sprawling petrochemical industry that synthesizes the plastics, fertilizers, and raw materials required for modern life. And heavy industrial manufacturing like steel and cement.
It's woven into everything.
These foundational sectors simply cannot pivot away from crude oil and refined petroleum products overnight. It is a grueling, multi-decade logistical process.
And a sobering reality is that while that incredibly slow, multi-decade energy transition is happening, the world itself is arguably becoming much more unstable.
Precisely. We are currently operating in an era defined by increasing geopolitical fragmentation, the breakdown of globalized supply chains, and acute, rising energy insecurity.
It feels more volatile now than ever.
It is. Strategic competition between major global military powers, the aggressive evolution of global sanctions regimes, and physical kinetic conflicts in energy-rich regions like the Middle East are not decreasing. If anything, the data shows they're becoming more pronounced and more frequent.
The risk is going up.
The logistical vulnerability we discussed earlier regarding the Strait of Hormuz is a perfect, terrifying example of this fragility. The global energy supply chain is incredibly tight. Even a temporary, localized disruption to a major shipping route or pipeline can send immediate, violent, inflationary shockwaves through the global financial markets.
So because physical oil is still absolutely vital to keeping the world running, and because the geopolitical map is increasingly fractured, these strategic energy shocks aren't going to quietly disappear into history.
Not at all.
In fact, the math suggests these massive, structured, oil-driven FX campaigns are likely to become even more frequent and potentially much more volatile in the coming decade. The framework we've unpacked today isn't just a history lesson looking backward at 2014 or 2022. It is the essential, mandatory playbook for surviving the next 10 years of global finance.
Without a doubt. Oil shocks rarely, if ever, produce isolated, contained movements. They initiate highly complex, globally interconnected market responses that ripple aggressively across commodities, sovereign bonds, global equities, and ultimately, currencies.
It's chain reaction.
Because foreign exchange markets are so hypersensitive to massive structural shifts in global capital flows and central bank interest rates, they will continue to be the central, primary arena where these macroeconomic adjustments unfold and where the wealth transfer is recorded.
So you have to pay attention to them.
Understanding this complex reality requires looking far beyond a simple daily price chart. It requires recognizing how a sudden geopolitical shock reshapes the entire global economic narrative, how that narrative redirects billions of dollars of institutional capital, and how that capital ultimately engineers these structured long-term market trends.
Which leaves us with one final, truly fascinating macro concept to consider. Throughout this entire deep dive, we have continuously discussed how the ultimate amplifier of these market campaigns, the gear that makes the whole machine run so fast, is the fact that global oil transactions are primarily denominated in the United States dollar.
The petrodollar system.
That global scramble for dollar liquidity is the engine oiling the gears of this massive international wealth transfer. But I want to leave you with this final provocative thought to mull over on your own as you watch the news this week.
This is the big question.
If global dollar liquidity is the absolute, undeniable linchpin for how oil prices dictate global currency values, what happens to these massive, highly structured market campaigns if the world ever successfully begins pricing oil in currencies other than the US dollar?
It changes the entire paradigm.
What happens to the petrocurrency framework if major exporters start accepting other sovereign currencies or digital assets for their energy? If that foundational gear is removed from the machine, how dramatically would that rewrite the fundamental established rules of global wealth transfer?
The implications would be staggering.
Who would be the new winners and who would be the massive losers? It is a scenario that would permanently change the math of the entire global economy. Thank you so much for joining us on this deep dive, for exploring the macro data, and for unpacking the true hidden mechanics of the global financial system with us. Keep questioning the headlines, keep looking for the hidden structures beneath the chaos, and we will see you next time.